What's up, peeps? Hope everybody's doing absolutely fantastic, and thank you once again for joining us here on the Daily Pills video stream of the day. My name is David. Let's go ahead and get right into everything because we have a lot to talk about here today. So we're, of course, going to begin with the big story of the day. We're talking everything banks. We got a big report from the FDIC, who is the regulator of banks here in the United States, talking about their solvency, how they performed in Q1, and where we can see risks going forward in the financial system. We'll then, of course, talk about a couple of big stock movers of the day. One that I'm incredibly excited to make fun of because Hindenburg Research is back killing stocks once again. Then we'll finish things up with talking about Zyn, everybody's absolute favorite product. So we'll break that down and exactly what it's doing for its current owner, Philip Morris, and exactly how it got to the position that it is today. Let's go ahead and get into it. So the WSO portfolio, I can't lie, it was another rough day. We were down 11 basis points. Both the S&P and the NASDAQ were up on the day. Now, they were up very small, so it was basically a flat day for all of these portfolios that we're talking about. The S&P rose a little bit under 20 basis points, the NASDAQ a little bit over 10 basis points. So we didn't underperform that drastically, but it definitely wasn't good. We were dragged lower quite a bit by particularly Builders First Source. That is a home builder company. It's one of our larger positions in the portfolio as well. They had a really rough day for the session. So we'll blame it on Builders First Source. And once again, I'm going to blame this on my dad. Just like I did in the written edition yesterday. Dad, go out there and build more houses, please. Particularly one for me. That would be absolutely fantastic. Anyway, with that said, let's go ahead and get into some of the banana bits for the day. So first and foremost, CNBC, they came out with an article where they're breaking down Keith Gill and his trading strategy. So they're talking about exactly how this guy went from having $53,000 in GameStop to now nearly $300 million. I mean, absolutely one of the greatest retail traders of all time. So it's pretty interesting to see, and that article is definitely worth the read. Now, we also did get some data on the current share of housing units that are being constructed, definitely not by my dad, that are being constructed, built for rent. So a lot of homeowners are very much preferring to move into their own domicile, but to still be renting it. I don't exactly know what the benefit to doing so is, besides not having to pay property taxes. Really, the benefit to renting is if you're going to be somewhere and you know you're only going to be there temporarily, like under 3, 5, especially 7 years, it's probably fine to rent. Like, that's basically the way to go. But it seems like that is very much where the housing and shelter market more broadly are headed. Now, everybody, a couple of years ago, we were all hyped up about this fight between Elon Musk and Mark Zuckerberg. We thought it was going to happen in the damn Coliseum. That didn't happen at all, but it is happening on LinkedIn. It's just not between Zuck and Elon. It's between Elon and Meta's head of AI. Meta's AI head came out with this post yesterday. It was honestly absolutely wild. Basically, shitting all over Elon Musk. I don't know if Mark Zuckerberg would have approved this, but I have to say he's probably not too upset about it. And speaking of Elon, he also had a big news story for the session. He basically came out and told NVIDIA to redirect a bunch of chips that were supposed to go to Tesla to xAI and to X. So they're going to his other companies, his other ventures. Tesla must have more than enough. I really don't know what the other reason would be, but that's definitely worth checking out. Of course, following the artificial intelligence story. All right. With all of that said, let's go ahead and get into the big story of the day. And we are, of course, talking about banking on banks. Nobody likes getting exposed, especially if you happen to be Drake right now. That is one of the worst exposures that anybody has ever seen, but that's going to happen when you start beef with people like Kendrick Lamar. Now, unfortunately, banks have been beefing with all of human history, every single person for all of human history. So, it's a little bit tough for them to not get exposed constantly every single day. And I'm not talking about the reports that they publish, quarterly reports, annual reports, or anything like that. I'm talking about their mommy and daddy, Mr. and Mrs. FDIC, coming out here with the quarterly report on banks. Specifically, we're talking about the quarterly banking profile from the FDIC, or the QBP for short. So it's the QBP from the FDIC, which rhymes, so it's pretty sick if you ask me. Basically, what this does is breaks down some of the publicly available data for banks. It talks about how they performed in Q1. It's a report to Congress, but obviously it's available to the public because the U.S. likes to pretend that we're still some kind of democracy or that people's votes matter or whatever the fuck. So that doesn't really matter. But basically, they come out and just report on all of these numbers. So absolute losers like you and me who care about this stuff, we can go ahead and nerd out for a quick second. So this is a monster of a report. Now, it's only 32 pages long, but if you open up the actual report itself, it's pretty much all the absolute smallest font possible, and it's just line after line after line going over each change of certain different line items. Everything from revenue growth to changes in coverage ratios, which we'll be talking about in just a quick minute, but that's what we're focused on here today when it comes to banking. So one of the more important things that we're talking about here is going to be, of course, quarterly net interest margin. So net interest margin, this is effectively the ratio of net interest to total revenue that these banks are going to be making. So it's the percentage of total revenue that comes from net interest. Net interest, of course, being interest earned on loans minus interest paid out on deposits. So what are we looking at for Q1? You might think that this would be spiking higher given that rates are so much higher, but absolutely not. It's actually been trending lower over the past couple of quarters. So we can see, basically since 2010, since the GFC, it's been on kind of a secular decline. That tends to happen. Rates tend to just fall as economies mature because there's less risk. So you need a lower rate to actually take that investment and make that risk. But what we're seeing right here is we saw a brief uptick in early 2023. We are now moving back down lower. So this isn't because rates are falling at all. It's because banks are actually starting to pay out some kind of interest on their deposits. Prior to, the rate hiking cycle that began in 2022, there was really no competition for deposits. Investors didn't give a fuck because rates were through the floor, so they weren't getting interest regardless of where they put it. Even if they put it in treasuries, money market funds, nobody was making any interest at all. Now, there's some competition for it. JP Morgan Chase, I'm pretty sure, is still paying 0.01%, but then there's banks out there like SoFi and other neobanks. SoFi pays like 1.5% on checking, and I think like 4.6% on savings if you have direct deposit linked up. So, that's where the competition is coming from. It's mostly these neobanks pushing those rates higher. So, quarterly net interest margin kind of falling. Obviously, that's not ideal for these banks, but it's great for consumers. The thing is, it's falling by such a small amount that it's kind of immaterial. Like, it doesn't really matter to investors who might be concerned about the banking system. But what does matter is certainly going to be a reserve coverage ratio. So that's what we're looking at right here. And basically, just to break it down for a little bit, reserve coverage, what we are talking about here is the ratio of the allowance for credit losses divided by total non-current loans. So what the hell does that mean? Allowance for credit losses, this is cash that banks set aside for a rainy day. It's basically the rainy day fund for banks. They save it for any loan losses that they get. Obviously, some people are going to default on their loans. So to ensure that the banks don't go completely bust every time somebody defaults, they keep a pile of cash on the side. So when we're talking about additions to credit losses, that's the amount the banks are putting in each quarter into that rainy day fund. Now, on the other hand, non-current loans, these are loans actively in default. So what we're seeing right here is this darker line that you see, it's actually trending lower in this direction. This is total non-current loans. So it hit this absolute peak in the post-GFC cycle. Obviously, that completely spiked. Then the allowance for credit losses spiked at that point as well and has now been trending lower, but not nearly as low as the non-current loan section of it. And then this blue line right here, this is showing the actual ratio of those. So it's dividing the allowance for credit losses by non-current loans. And what we see is that we're currently at about 192.8%, which is historically high, as we can tell by this chart, but it's well below the recent peak of about 203, 202% that we're seeing right there. So basically that tells us that banks are getting pretty cocky, despite the fact that non-current loans are actually slightly starting to rise. Banks are still feeling pretty cocky. They contributed quite a bit less to provisions for credit losses as a whole last quarter. So it's definitely something to keep an eye out for, because now it's starting to seem like these banks are entering a risk-on paradigm. So if I go ahead and go on to the next slide right here, what we're looking at is non-current loan rate and quarterly net charge-off rate. So this is very similar. These are non-performing loans at different periods of their maturity structure. So non-current, basically quarterly net charge-offs is kind of like when they officially write off these non-current loans. Like, non-current loans are loans that are either in default or about to be in default, and then net charge-offs are the ones that they're like, fuck it, we're not going to get any more money from this thing. So what we're seeing right here is that they're both on the uptick once again, and it's not like they're just rising slightly. It's like they're basically doubling from the beginning of 2022. So that's obviously concerning. It is still very low compared to historical standards, because post-GFC, post-COVID banks, JP Morgan is famous for the phrase a fortress balance sheet. That's basically where the entire banking sector moved. They did not want any losses regardless of how bad a catastrophe came down their way. So they have been building up these balance sheets for quite some time, and it seems like they're starting to take some risk on once again. Now, obviously, in the current state of the economy, that's probably fine, because the economy has been firing on all cylinders in the entirety of the post-COVID environment. Now that we've seen manufacturing slowing, like we talked about yesterday, and consumer spending slowing, like we talked about on Friday, it's starting to be a little bit concerning. It's like we're heading towards a slower period of economic growth. That doesn't necessarily mean we're heading for a recession or anything, but it definitely means that we're at least normalizing back to historical levels for the United States economy. Now, where it gets scary, however, is exactly what happened to Silicon Valley Bank and Signature Bank last year. For those of us who don't know, SVB and Signature, these are two banks that went completely bust in Q1 of 2023. Basically, the reason for it was because they had these enormous loan books where, basically they had these enormous bond portfolios. And when banks have bond portfolios, they're kind of trading along the yield curve. They're trying to maximize their return, balanced against the risk that they have under their own loan book. So they're buying these bonds as kind of a way to shield against that, because they know they're ultimately going to get paid back from the US Treasury. But the thing is, when you buy super long-dated bonds at a hella low rate, and then rates skyrocket faster than they ever have in the entirety of US history before, the value of those bonds falls through the floor. We all know this. Basic bond math is that when rates rise, the principal value or the price of bonds is going to fall at the same time. So that is going to take, basically what that means is that these banks, Silicon Valley Bank, what took them under was they had an enormous pile of unrealized losses. And so what happened was there was the tech recession going on, so these companies and tech investors and tech founders and stuff like that basically started to pull deposits out of SVB like absolutely nobody's business. And so they started pulling this stuff out, and in order to cover those deposits, because we know how fractional reserve banking works, you don't have every dollar sitting on your balance sheet. So in order to cover those deposits, SVB had to sell what's called a ~maturity and its available for sale bond portfolio. So those are a little bit different. Available for sale, these are bonds that you could sell if you wanted to. They're going to mature relatively soon, and you could tap into them for liquidity if you wanted to. ~maturity are bonds that you specifically mark to the side and say, we are not selling these under any circumstances unless the world is absolutely on fire. And for SVB, it did become on fire because once they had to dive into their ~maturity portfolio, everybody kind of saw the writing on the wall, and it was an absolute bank run right then and there. So that's the scary part about unrealized losses, is if there is a bank run, you don't have enough to cover deposits at the end of the day. And so when I click to this next chart, I hope you have another pair of pants close by to you, because you're probably going to need it after we talk about these numbers right here, because what we're looking at right now is the total amount of unrealized losses by all depository institutions in the United States. As we can see, for this entire period, it's relatively standard, relatively stable. They actually spiked up. That's unrealized gains that had spiked up quite a bit in the post-COVID environment, but boom, immediately through the floor as soon as rates start to spike higher. These banks and their existing bonds, the value of them, the prices paid, fell absolutely through the floor. So right now, in the first quarter of 2023, banks are sitting on about $515 billion of total unrealized losses. Yes, that is $500 billion in unrealized losses that is currently held by these banks. $110 billion of that is held by Bank of America alone. And so that is an extremely scary number. But, you know, it's not necessarily something worth freaking out about. Like, we could run a very clickbaity headline and say some shit like, oh my god, $500 billion in losses about to hit the US economy, but that's not going to happen. So the way that this works is outside of any extenuating circumstances, like a black swan event basically would have to come in order for deposit flight to reach such a level where this would crash the banking system. Now, the thing is, it's a very low probability event right now, but because the impact of such an event would be so absurd, so it would probably cause GFC 2.0, quite honestly. We can view this as kind of a black swan style event on the horizon. Now, by definition, a black swan is something that you don't necessarily see coming. So the fact that we see this coming just means it would be a really big shock to the system. And by the way, most swans that I've seen in my life are white. So hopefully this one remains white and in that position. You know, given the slowing economy, consumers getting a little bit more nervous, this is definitely something that we're going to want to be on the lookout for. Pay attention to these previous charts that we talked about here, like the especially this one right here. We want to make sure that the reserve coverage ratio is staying elevated. If that drops below like the 150% mark and these unrealized losses are still through the roof, then we'll start to get a little bit nervous over here at the Daily Peel Global headquarters. So with all that said, let's go ahead and move on into some of the stock names for the day. First of all, we have Carnival Cruise Lines up 5.8% for the session. This is the world's largest cruise ship operator, largest cruise line, and they're getting even bigger. So if you like to strap yourself into a fucking box floating in the middle of the ocean, consider this your Christmas day, because effectively what Carnival is doing is just rolling another brand, P&O Cruise Australia, into their flagship brand, being, of course, Carnival. So they're expanding capacity under that same brand headline. Investors loved it because the travel boom is largely still alive. So they were basically saying, yeah, grandma and grandpa are going to fucking eat up those cruise ships and go ruin it for everybody else who's on board. So Carnival Cruise Lines up 5.8% on the day, kind of an unexciting story. Now, not an unexciting story, on the other hand, is, of course, Boot Barn. I mean, this company should be worshiping at the altar of Morgan Wallen and Zach Bryan at this point, because I don't think anybody has created more wannabe cowboys since John Wayne than these two, and that's exactly what's driving sales for the Western apparel maker Boot Barn. So they came out and said they've seen already 1.4% same-store sales growth for Q2. It might not seem like a whole lot, but given the environment that we're in right now with hella depressed discretionary spending, it's great to see that, bejeweled fucking belts and boots are still at the absolute top of the list, arguably have moved into consumer staples territory instead of discretionary. So the stock was up 4.5% on the day on that announcement. Moving on down below, we have Bath & Body Works down 12.9% on the day. Looks like a lot of people are joining me here. I haven't bathed or worked on my body in literally years, and the stock price is starting to show it. I must have a lot of other people getting on board, because, like I said, the share was almost down 13% for the session. Basically, they came in, they had relatively weak earnings. I mean, the earnings did beat estimates by a very small amount. And they made the mistake of being just way too honest and came out and said what they actually expect for Q2, and that is actually an earnings decline. So the company reported about 38 cents per share for the current quarter. Estimates were somewhere closer to about 33 cents per share, but the market was also looking for they were looking for 38 cents a share in Q2, but fucking Bath & Body Works came out and said that they were only going to be able to deliver about 31 to 36 cents per share. So the market completely dumps. I mean, down 13% for fucking 2 cents a share. Like, Jesus Christ, get a fucking life, Mr. Market. But still, that's the situation that we're in right now. It shows how kind of coiled the S&P and the broader market is at this stage. Finally, we have Axos. Now, a lot of you might have thought I just said Axios. I absolutely did not. I am talking about a financial services company, basically a lender to largely real estate providers, whether it's brokers, developers, whatever it might be. They provide like mezzanine financing for a lot of construction and different kind of shit like that. So Axos, ticker is AX, they were down 4.1% on the session because the stock serial killer is back in business. I mean, Jesus Christ, this was absolutely terrible. The shares, this company, it came under fire like if you were to put on a MAGA hat and walk through one of those Free Palestine encampments or something. Like, you would have gotten less hate than this company did in the morning session on Tuesday. So with Hindenburg coming out and saying, fuck this thing, this is an absolute short, the market kind of freaked out because Hindenburg Research has made quite a name for itself. These were the guys that killed 𝗪𝗏𝗪𝗏𝗪𝗏. They called out places like Adani Group and other firms like that. They had some misses as well recently, which is why the stock was down only 4.1%, because they've been a little bit wrong lately. They didn't catch SVB and shit like that. So the market's giving them a little bit less credit than they usually do. The stock was down 17% by 9:30 a.m., but finished the day down just 4.1%. The allegations are that the company's loan book is a lot riskier than they currently disclose, and they use really shitty underwriting standards. It's an absolutely enormous report. Sign up for Hindenburg's emails and just read through the first 10 or so bullets. You'll basically get the picture every single time. Moving on to our final story of the day, we are talking about the new Adderall. The 1980s, it was cocaine. By the 2000s, it was all about Adderall. Welcome to the 2020s, where we have Zyn. I know a lot of you guys out there absolutely love Zyn. So let me just say, Mom and Dad, please turn the camera off right now if you are currently watching this. But check out these bad boys right here. I know plenty of you probably have these popped in right now as you were watching them. It's a great writing tool. It kind of helps you lock in and focus a little bit. Although, when you first put it in, it kind of burns a little bit. But much like tasting alcohol, you just got to get used to it. So, trading floors across America, fraternities across America, pretty much anybody that's cool and not a complete loser has tried Zyn at this point. Not necessarily that you still use it, but you've probably at least tried it or heard of it. And that's because this thing has quickly become one of the biggest nicotine products in the United States. So Zyn was originally launched in 2014 by a company called Swedish Match. The Swedes are killers of nicotine. They absolutely know what's going on. I think there's another one that's called Scandinavian or something, where you can get as many as 40 milligrams in a single pouch. This one's only 6 milligrams right here, and I'm absolutely not advertising it right now, because as we'll talk about in a quick second, I'm pretty sure that's illegal to do, although it does seem like it's a bit of a gray area. It looked like the camera was a little bit tilted right there. But either way, kind of like chewing tobacco, basically what you do for the uninitiated is you throw it in your upper lip, and it kind of shards your gums right there a little bit. Like, it has these little tiny microscopic shards of glass that cut open your skin, and the nicotine goes in there into your blood system through those shards, and it basically pumps through your entire body via your heart right here. So much like alcohol and cocaine, it's probably going to destroy your heart eventually at some point, but I also don't know if that's true, so please nobody come sue me or anything. What I do know is true is this absolutely explosive growth that Zyn has seen in recent years. So as we can see, beginning back in 2018, there were 6 million tins, or cans as they call it, but I call them tins, shipped in Q1 of 2018. We have 443 million in Q4 of 2023. These are annualized rolling 12 months rates, by the way, so this isn't the total quarterly volume. The company expects 2024 to have a rolling rate of 560 million tins of Zyn. In other words, that's a 91.1% CAGR from the beginning of 2018. Everybody loves it. If you go into any college, any work environment, literally anywhere in the United States, somebody has Zyns. And it's been pretty interesting to see because not only is it wildly popular, but for a company like Philip Morris that was on the brink because its products were just getting completely obsoleted, nobody smokes cigarettes anymore. I mean, to Gen Z, smoking a cigarette is like punching an old lady in the face. Like, it's just, you don't do it. Even though it might be kind of funny, you just don't do it. Obviously, drunk cigs don't count. That goes without saying, but I'm going to say it anyway, just so that we're all on the same page here. But the other great thing about Zyn is that it's not only a revenue grower, but a margin grower as well. So what we're seeing in this top line right here is the different revenue growth rates for Q1 of 2024 across all of Philip Morris's products. So they have right here, net revenues 11%, combustibles grew 3.7%, and smoke-free grew 24.8%. Not only was it the fastest growing, it's by far the highest gross profit. Zyn is currently chilling at 37.5%, while gross profits overall, or for combustibles, for their vapes and cigarettes, that's at 2.3%. That brings the total gross profit to 13.7%. This is basically going to be a Zyn company in a couple of years if it keeps going in this direction. So the big reason for it is highly attributable to a grassroots marketing strategy. Now, the thing is, you can't advertise tobacco in the United States because the FDA is a bunch of losers and they don't want you to have any fun. So they can't advertise tobacco. Nicotine becomes a little bit of a gray area because there is no tobacco in Zyn products, but there is a whole lot of nicotine, 6 milligrams per pouch to be specific. But it's kind of a gray area. I couldn't figure out, ChatGPT couldn't really tell me either. I saw some video on YouTube where they were talking about this too, about like a bunch of podcasters advertising for Zyn, and it's technically not legal, but then you look at podcasters like comedians like Bert Kreischer and Andrew Schulz. These are big users of Zyn, and they won't even be advertising on it. They'll just be sitting on their podcast and say to like the other hosts, like, yo, you want a Zyn or something like that. That's exactly how Zyn blew up quite a bit. Not necessarily through these podcasts and everything, but by building its own niche in pop culture. So you get, like, as soon as you get Brad on the hook, where Brad comes in and buys a Zyn, he's going to go back and show Chad, Thad, and every other lad exactly what Zyn is and how much he absolutely loves it. And that's how you grow a product like this, especially a drug product that you can't necessarily advertise. Now, when you use really colorful packaging, it is very eye-catching. So when I'm fighting with, when I'm fighting with the store clerk at fucking Quick Trip down the street or something over my Slim Jim discount, I see these brightly colored Zyns in the background and I'm all about it. So that's basically the story with this stuff right here. God, my girlfriend really wants me to quit them, and I am trying, but it is, I haven't been using them for too long, but it's a fucking bitch to try to quit these things. So that's how I know I fucked up by starting to use it. Mom and Dad, I really hope you weren't watching this session, so I'm going to go ahead and take Zyns off of our screen back here, and we can forget that this ever existed. I'm excited to see you guys on Thursday, by the way. But anyway, let's go ahead and finish up with the quote of the day. This one's from Mr. Jim Simons. We don't know if he was a registered Zinner, a born Zinner, but we know that he loved nicotine. This guy smoked in pretty much every picture that was taken of him, so he's a big fan of nicotine, although probably wasn't, to him, you would have been a huge loser if you used it. So he probably would have called us all losers. But either way, one of his favorite quotes that makes him a real winner was saying, "Don't be afraid to take risks and embrace failure. That's where the best opportunities often lie." Look at this. You guys are watching me fail in real time, and it's a lot of fun on the way. It's a great opportunity for enjoyment and excitement. All right, that about does it for us here today. I've been talking for way too long, as always. I can't believe Patrick hasn't fired me quite yet, but I am very sorry. I'll try to keep it shorter in the future. Happy investing, happy trading. Bye now, apes.